Sure.
And then I'll give you an introduction, and then we'll let you roll in the show. Okay.
Sure. No problem.
So everyone, thank you very much for coming today. It has been a crazy, crazy week. I'll tell you, I haven't seen a crazier week since last week. But I'll tell you, I really appreciate you all making it. For those who signed up and for those who made it today, I know, and those people who don't have water, or even some people who still don't have power, our hearts go out to you, you know. So just please, if you hear of anyone who doesn't have power or lights, please have them contact me. I'm more than happy to help out in any way. McNair Center is always here to support our fellow tech centers. So that being said, we're very lucky today to have a great source and a great person who's providing tools for entrepreneurship here in the community. Winston LeBay, of course, it matters if you're coming from Louisiana or not. Winston LeBay is here to tell us about all the goodies that the SBA has. And I'm going to tell you right now, the Small Business Administration is probably the greatest investment, the greatest thing that's going on in this country for entrepreneurs, hands down, hands down. And I'm very happy and very honored to have Winston here today to talk about this. Let me give you a little background of Mr. LeBay. Winston, he joined just the SBA I think it was in May last year, huh? So not too bad, catching up. He's the head of this cover. I have a little spots cover and everything here. He's the head of outreach, or heading up outreach and marketing specialist. Prior to joining the SBA, Winston was a chief lending officer for a local independent bank. Maybe you can mention a little bit about that. Winston has over 25 years of commercial lending experience, specializing in SBA, because the SBA does, of course, a lot with banking. CNI, which I'm not familiar with, but I'm sure he can enlighten us about CNI. Non-for-profit and real estate lending, of course. Winston is a native Houstonian, God bless you, and an honors graduate of Texas Southern University, where he graduated with a degree in finance. He also attended Houston Community College. Houston Community College is one of our partners. Our heart go out to HCC, where he learned his associate degree in real estate. He's also served 4 years of active duty Army. I don't know if you know, Winston, but we're running the VEP program. Many of you veterans out there today, Veterans Entrepreneurship Program, we're running that over the next 3 or 4 weeks. If you are a veteran and logging in today, please do reach out to me. I'm more than happy to hook you up with our VEP partners over at HCC. Winston has served also on several boards, including the Sam Houston Area Council, a small, wow, Council for Boy Scouts of America, Furniture Bank, a nonprofit, and the Fort Bend Chamber of Commerce, also one of our big partners for the VEP program. So with that being the introduction, you take it away, Winston. I'm going to switch it over so you can share your screen.
Okay. Thank you so much, Patrick, and thank you for all your students and colleagues for allowing me to speak to you all this afternoon for a few minutes. And so hopefully by the time I finish, you may hopefully walk away with information that you were not aware of that can help you going forward as far as being entrepreneurs. Do you see the screen, Patrick?
Perfect. You are bright and shining.
Okay, good deal. So with that, I'll get started. Again, I'm going to touch on SBA products, but I'm going to go in more depth. I'm going to really present information to you from a lender's perspective, being that I was a commercial lender for 25 plus years. I worked at the independent bank where I was a chief lending officer. That's Unity National Bank. But I also I cut my teeth, as they say. I started my banking career at Texas Commerce, which is now Chase, JP Morgan Chase. Also worked at Amegy Bank and Wells Fargo. So I worked at the large global national banks, regional banks, and also the independent small and mom and pop type banks. So I say all that to say that I can bring different perspectives to the table. In my role as outreach and marketing specialist, I go out into, well, we don't go out into the community right now, but prior to COVID, if I had been on board with the SBA, then I would be out probably doing this one in person, visiting with chambers, universities, etc. So with that, I'll just go ahead and dive right into it, and I'll stop at different intervals and allow you to ask questions. So the SBA is a federal agency that was created to aid, counsel, assist, and protect the interests of small businesses. The agency helps Americans start, build, and grow businesses through an extensive network of field offices and partnerships. And our mission is very clear: to help small businesses grow, expand, and recover. And the word recover really pertains to the COVID-19 or hurricanes, disasters, recover from those type of situations. So the SBA always steps up to help not only small business owners, but homeowners and renters as well. So we make connections, open doors, and focus on small businesses. So what I'm going to do, if you don't mind, Patrick, I'm going to turn off the video just for a minute because it tends to freeze my screen sometimes, and I don't want to get frozen out. Am I still? Uh-oh.
Looks
Oh,
good.
just want to make sure I'm still there, right? Okay, good. Thought I lost you guys. Okay, good. Sometimes I get disconnected. Okay, with that, let me move on. So getting a business loan. So what does a small business owner need to do to get a bank or lender to say yes? Where do you start? The first step is to communicate about your business. And I'm going to turn the video back on because I don't want to lose you guys and not realize it. Determine the correct contact. So what tends to happen is a lot of times a small business owner will contact a lender, bank, credit union, etc., and they'll be introduced to the wrong person. Nothing against a personal banker. My wife's a personal banker, manager at Wells Fargo, but their specialty is more consumer lending, opening accounts, checking accounts, savings accounts, etc. You want to speak to a commercial lender or a business banker because they specialize in underwriting. That's the term, underwriting business loans. Most lenders, banks, etc., they have criteria on their website that speaks to what documentation is needed, but I always share with business owners, don't just rely on the website. Make sure you speak with someone. And again, we're living in some interesting times right now with COVID-19. So most of the interaction is virtually by phone or email, whereas prior to COVID, it was more face-to-face. And then ask the lenders about the types of loans that they do. And I'll get more into that in a minute. Here. So what matters most to a lender? No matter who you ask to lend you money, the lender will be looking for a business owner who knows the business, has the ability to run it well, and willing to work hard to make it succeed. A business that is financially sound, or if it's a startup, appears to have the ability to make enough money to pay its bills. Collateral will typically be required. We'll get into that as well. And an equity investment or equity injection from the business owner. Someone starting a business, most lenders, and again, I'm speaking from my experience, I can't think of a lender that would probably do 100% financing. So most lenders require cash equity, anywhere from 10 to 30%. We'll talk more about that. 5 C's of credit. Let me back up to the 5 C's of credit. So this term is universal, meaning that whether someone is in Miami or Los Angeles, anywhere in the country, if a business owner or a potential business owner is speaking with a lender and the term 5 C's or the phrase 5 C's of credit comes up, it's universal. And this is what it is. It's character, cash flow or capacity, collateral, capital, which is equity, and conditions. And so when you go into, or not you, or at some point you guys may apply for a business loan, the lenders will look for these 5 C's, your character. So years ago, and I make light of this, but years ago, many years ago, I was in banking 25, 26 years, but I'm talking further back than that. There was such thing as a character loan where someone could go into a bank, if you will, and they mention their mom's name or dad's name or uncle's name, and they get the loan done because they knew each other. It was a character loan, right? Well, now your character is really based on how well you pay your bills, how well you pay your credit history, your credit score. That speaks to your character. And so it may sound insensitive, but that is what lenders look at. When they say character, they're referring to how well you pay, okay? Your FICO score can be affected by a variety of ways: how much money you owe compared to how much you make, how much money you owe on personal and business loans, and other credit factors as well. Bankruptcies, collection items, all of that affects a person's credit score. Now, and speaking of credit score, what I share when I'm speaking with and I'm going back to my previous life before my SBA days, When I spoke or used to speak with a potential borrower, what I would tell them, and I still do that now, access to capital. Matter of fact, this webinar that I'm presenting to you guys right now is really access to capital, but I've added some more information to it. But I have another webinar this afternoon with the city of Houston, access to capital. And so when I speak with business owners, what I tell them is, to reach out to the lender, kind of develop that relationship, that business relationship or rapport, and find out what lenders look at. What say, if you're talking to bank, I'll just say Chase. If you're talking to Chase, or you're talking to Amegy, or you're talking to Prime Way Federal Credit Union, you want to find out what their philosophy, what their lending culture is, how they look at credit scores. Some lenders, their credit score minimum could be 650, 675. Some lenders, it could be as low as 625. So you want to have that kind of dialogue early on in the process, so you'll know, if you want to continue on with that bank that you're at, or do you want to reach out to another lender who may be more liberal or more aggressive. That's the term I used to use, aggressive, meaning more liberal and flexible in their terms. Cash flow is the most important C. I used to do webinars when I was a lender, and the title was Cash Flow is King, King, because that's how you repay a loan. Regardless of how strong a person, an individual's credit score is, no matter how strong the collateral is, no matter how much cash equity they bring to the table, but if it's an existing business, and lenders will require 3 years, usually 3 years of business tax returns and 3 years of personal tax returns, if it's an existing business, lenders will want to see, does that business generate enough income, cash flow, profit to support the payment? So at the end of the day, if the business is losing money, the other C's do not matter in that case. So cash flow is king. And I'll talk about that further later on. Existing businesses, again, I spoke to that. Lenders will ask for 2 to 3 years of tax returns, business tax returns. And if it's a startup business, I don't know of any lenders that will finance a business without a business plan. And we'll touch on that shortly as well. The business plans are very important. Matter of fact, let me just speak to that. Business plans are not only important to a startup business, but they're equally as important to an existing business. You may ask yourselves, you may say, why does he say that? Well, at the end of the day, and I'm sure Professor Patrick has said this, or Dr. Patrick has said this, but that business plan is your roadmap, okay? If you've been in business, say 4, 3 years, 2 years, 4 years, and now you're saying, okay, in the next 2 to 3 years, I'm going to double my revenue, my sales. Well, that business plan can help you stay on track. You can look at it, the financial projections, we'll get into that. Where you said you were going to be in 6 months and where you are, and you can tweak maybe your operations, how you're marketing, whatever it takes to get you to that next level. So business plans are important for existing businesses as well as a startup. Now, collateral, and I'll talk about SBA shortly. So again, most lenders that I know of do want to be able to secure business assets as collateral, whether it's your equipment, whether you own the real estate where you're operating or from where you're operating your business, inventory, accounts receivable. Lenders do want to be able to place a lien, a UCC-1 filing, if you will, against assets. Now, at the end of the day, quite honestly, usually the assets may not secure the loan 100%. That's okay, because as long as lenders can touch it or have some source of collateral, then it makes your deal a stronger deal. And then the SBA guarantee, and I'll talk about that shortly, can help also to strengthen your loan package, okay? Capital injection. I'm just speaking to these. I'm not going to read every bullet point or every line item, but when you start a business, that third bullet point, you see the second sentence, it reads skin in the game. Lenders want to make sure that that business owner has skin in the game, has something to lose, if you will. And so that's where that cash equity injection comes in. So starting a business, you will be required, a business owner, potential business owner, to demonstrate or to have the cash equity. Let's say you need 10%. let's say it's $100,000 loan. Let's use 30%. $100,000 loan, 30% cash equity is 30,000. So now the lender will finance 70,000. Well, it goes a step further than just saying you have the 30,000. You have to provide your personal financial statement, bank statements to show that you have the cash equity or the cash liquidity on hand, and that you're not going to go out and borrow the money. So those are ways that lenders will document and prove up that you do have access to the cash. So again, there are not many lenders out there, none that I can think of actually, that will finance a business 100%. And then conditions. So the most important condition you see, it speaks to the loan amount and interest rate. But at the end of the day, the condition, the external condition that really impacts a decision is how well businesses are doing in the respective industry. So the example I use all the time, I love it to use this example, that is let's say someone wants to open a restaurant or a sandwich shop, a deli, right? And first of all, restaurants are very risky, so that's an industry all by itself. But let's just assume it's a franchise, it's a Subway or one of the other franchises, and it has a good reputation. So therefore, the chances of it being approved are pretty good based on other conditions, such as the other 4 C's of credit. But one of the other factors to take in mind, what could impact that industry? What could impact your cash flow stream? So let's say you're opening the deli across from Schlumberger or Exxon or Halliburton, one of the oil-related businesses, right? And so you're doing your business plan and you're excited because you're going to open up this deli right across the street, directly across the street from one of those firms I just mentioned. So you're saying, okay, I'm going to be able to capitalize on all of that, those employees for lunch, because they'll just walk right across the street. I'll be blowing and going, right? Well, but what you have to factor in, what happens when the economy slows down? What happens when the oil industry has a downturn, if you will? What happens? They start laying off. So when they lay off their employees, that's going to impact your revenue, okay, your profits. So you have to factor in things like the unforeseen, unknown, and I'll talk about our resource partners and how they can assist with you identifying some of those challenges or issues. The other one I used years ago, I financed a lot of children's. Well, I did some children daycare centers as well, but I financed an adult daycare center years ago, and startup. And the 2 principals, the individuals, had years of experience. They were both nurses, so had the experience, cash equity, all the things I needed. Business plan was very tight, very good. And so at the end of the day, we financed it, working capital. But before they could open, they had to have the state health department to come in, the inspection, so they could get their permits, licenses, right? Well, what they didn't think about, what they didn't consider was at that time is the state of Texas had a backlog, huge backlog. So it took months for the state to come out, but they had to go ahead and open and start paying staff because they had to demonstrate that they had at least 2 clients, 2 patients, if you will. So they had to have at least 2 customers. If you have customers, especially a senior citizens, you have to have a medical person on staff. So they were already going into spending their working capital, 3 or 4 months of it before the state came out. They almost had to close the doors before they even opened. So you got to think of things like that what could affect your business. So those are conditions. All right, now we get into the SBA. The SBA, so just to clear this up, the SBA does not loan money directly to small businesses. Years ago, probably in the 70s and early 80s, they did. I was kind of an entrepreneur myself, and I looked into it at that time and had to go directly to the SBA. But the way it works now, the SBA guarantees the loan for the lender. The borrower goes, or the business owner will apply through one of the SBA approved lenders for the Houston, or it could be across the country actually, but speaking of Houston, we have a list of approved lenders for Houston. So they go through those lenders. The lenders all follow the same guidelines. There are no differences between one lender and the other. So that's what the SBA does, and it mitigates the risk. I talked about collateral, and I have an example here later. I think I'll get into that later, but the SBA guarantees anywhere from 75% to 85% for the 7A loan program, which is the primary loan program. Maximum loan amount for that program is $5 million. And I go into the eligibility and ineligible businesses in a minute. And then if the loan is less than $150,000, the guarantee is usually 85%. So in essence, let's say the loan is 100,000, the SBA guarantees 75%, which is 75,000. Well, at the end of the day, if say the borrower defaults on that loan, the lender can then contact the SBA so that the SBA can go ahead and honor that guarantee of 75,000. So you can see how that will help to maybe motivate, if you will, a lender to be more aggressive, more liberal, if you will, in their lending when they know they have this SBA guarantee to fall back on. And then there's the 7A SBA Express Loan. The guarantee is 50% for that one. Maximum loan amount is $350,000. I may have said this already. Maximum on the general 7A is $5 million. And so with the SBA Express compared to the 7A, the SBA Express is the only loan program, SBA loan program, where the borrower can apply for a line of credit or a term loan. Term loan is where you're paying the same interest, principal and interest payments monthly for so many years. A line of credit, revolving line of credit, is where you pay interest only on the outstanding portion. And I want to speak to that in a minute. On the general 7A, it's just a straight term. You're paying the same principal and interest payments monthly for say 10, even 20 years on the 7A, general 7A. Now on that Express, the line of credit, what I caution business owners about when they apply for a line of credit, whether it's an SBA Express or just a traditional line, you have to be very disciplined to use the line the way it's supposed to be used, revolving line. The key word is revolving, because at the end of the day, let's say someone applies for the line of credit Express, let's say it's a $200,000 line, and they get approved for it, and they close the loan, they book it on the system. That means they close it, it's booked. So now the borrower has access to it. The borrower contacts the lender and say, okay, hey, can you go ahead and advance all of that into my operating account? So that's $200,000 advanced, right? Day one or day two. So now they're paying interest, say 6%, paying 6% interest on that loan every month based on that outstanding balance. What they're supposed to do, however, since the word is revolving, is when the borrower is paid from their customer base, they're supposed to be disciplined enough where they're paying down that line, say pay down 50%, from 200 to 100,000, or maybe they pay it from 200 to 50 and then use it again and then pay it down, use it again. So it's called revolving. A lot of times in my past life, what I saw happen is that they had the right intentions, the borrower, business owner, approved for the loan, advanced it, and then they just paid interest because it was easier just to pay the interest, smaller amount. 12 months later, when it was time to review the loan, the lender looks at the history of it and see, okay, they never revolved this line the way they were supposed to. So what we're going to do now as a lender is we're going to close it, freeze it, and then term it out. So whatever's outstanding, let's say 150 or let's say 200,000. Now that lender places 200,000 on maybe a 5-year term. That's a huge payment every month, right? They have no more access to it to use it for working capital. So it could put them in a bad position. So when I was a lender, I was very conservative when I approved as a chief lending officer, lines of credit. And chief lending officer, what that means really is at the end of the day, I was in charge of lending. And so every loan that was done, approved, even though it may have been above my limit to approve it, it would go to loan committee, but I still had to sign off on the loan before it even went to loan committee. So I pretty much said, by me signing that document, I'm saying that I support this loan. So I would have to be really, really, I don't know if careful, but just know what I was doing, right? And so that's what the chief lending officer, that's just part of it. You have to, a lot of other things you have to do, meet with the OCs, regulators when they come in and examine the bank. So it's a lot of things you do. Moving on, so use of proceeds for the SBA loan can be used for the following: start a business, expand it, leasehold improvements, working capital, renovations, inventory, equipment, etc.
Winston, you mind if I take interrupt you? I'm sorry to
stop me. Yeah, stop me anytime, please.
I think this is a good point to kind of like ask a few questions, you don't mind.
Sure.
And one of the things when I look at this program and it comes to mind is succession planning. As you know, probably from the SBA, we're coming into one of the largest transitions of small and medium-sized businesses in America, I think in American history.
Right.
Whereas a lot of small and medium-sized business owners I think the average business owner is like 58 years old now. What opportunities would there be for, let's say you have a younger person getting their MBA. We have a few people who are getting their MBA on here that would be interested in taking over one of these businesses. Could they come to the SBA and say, hey, look, Joe Jones is selling their landscaping business. They've got 15 workers. They've got about $1 million in cash flow a year. They've got a good reputation. They've got a loyal customer base. What opportunity would it be for a younger person to come in and take over that operation? And what kind of financing options would there be to them? Maybe it wouldn't be their own family business, but maybe it would be a family business for them to take over.
Great question. You must have had my phone tapped the other day. I was on the phone. No, I
used to do this. I worked with the SBA for 2 years on the
yesterday,
same
and
issue.
so
That's why.
so yeah, because so it speaks to. So let's. I'm gonna talk about it this way, and you stop me. So let's say if the gentleman that called yesterday, he and his co-worker or colleague, they work at this company. I'm not sure what industry it's in, but they've worked there combined 20 years between the two of them. And the owner's ready to, retire and sell the business to them. And so they're interested in buying it. And so what I share with them, Patrick, in the class is a couple of things. One is whenever you're buying a business, whether you're already working in the business or you're outside the business and you're notified by, say, a broker, a business broker that someone wants to sell their business, then let me just touch base on it this way. First, what a bank will look at, because again, we just guarantee the financing, so you still go through a lender. With the lenders, what I looked at as a lender, you look at first, okay, the experience. So the two guys that I'm referring to, they had the experience because they were already there working, right? But let's say someone that's not already working for the business, and they're from the outside looking in, and now they want to buy a business. So what lenders will look at is, do you have experience in the industry? Okay, that's going to be number one. Well, not number one, but that's going to be very important. Do you have industry in that specific industry? Okay. Let's say you don't have experience. There are ways to mitigate that. And what you can do in that case is if you were to, say, purchase the business, then you want to, retain some key employees, maybe a key manager, put them on an employment contract. You don't have to make them an owner or anything like that, but you put them on a 2-year employment, 3-year employment contract where you're showing that you're going to retain that manager, that key employee, a key manager. That will help to mitigate the fact that if you don't have the experience. So that's one way to do it. That's one way to do it, unless you're bringing someone else in as a partner and that person has experience as well. So you have to address the experience factor, because lenders will more than likely decline the loan if they cannot get comfortable with the purchaser, the person buying the businesses, their experience. That's number one. Number two is the equity injection. So I talked about 10 to 30% equity for startups, right? On a business acquisition, you typically are going to be looking at around anywhere from, I usually say 20%. That's the way I structure my deals. But every lender is different. Some will structure it with, say, less than 20, but 20% is usually kind of the norm. So you have to show that you have that 20% cash equity injection to inject towards that purchase price. Now, another way to mitigate that as well, and I don't want to say around it, but mitigate it is, and this is what I shared with the gentleman yesterday or day before, if the seller is willing to owner finance, let's say the purchase price is $1 million, 20% is 200,000. Well, you only have 10%, 100,000. Well, if that seller is willing to finance the other 100,000, and not only finance it, but put it on, call it owner finance, place it on a term where you don't have to pay them for the first.
Can you all hear him?
No.
I think he's stuck. You can see he's mid-sentence.
Yeah, I think his internet access may have went.
Okay, hold on one second. Let me reach out to him real quick. Give me 1 minute. Sorry for the delay. Okay, give me 1 minute. I'm sorry for the delay. I'm going to reach out to him and just have him log back in.
You there?
We were listening to you, and all of a sudden you took off on us.
Yeah, no, it does that. Every time I'm on Zoom, I get disconnected at least once. So hopefully that's it. So let me go back and share my screen.
No worries. But I think you hit on a great point, and that's something that I'd like to try to find a way to work, with the SBA, because I know there's a lot of business owners out there who want to transition, but they don't know how.
Mhm.
And we have a lot of bright minds here, Joseph and Deborah and Omar. They're all starting their own businesses now.
Oh,
So I think it's really, I think there's a lot of opportunity that can be made, like matchmaking as well. So, but anyways, it's just a thought. But thank you very much. I think you really hit on it, though. It's very important.
Well, stop me anytime as we go through, because I know I may run out of time. But yeah, there are ways to mitigate some of the requirements when it comes to experience and cash equity, things of that nature. So just be mindful that there's always a way, if you speak, especially if you're speaking with a seasoned lender. Okay, so I will move on here. Okay, this is that example. I think I spoke to it already, where if the loan is 300,000, the SBA guarantee is 75%. Equates to 225,000. You can see how that guarantee can really help motivate, or maybe if the lender's on the fence, they get off the fence, because now they go, oh, I have a 225,000 guarantee. My exposure is only, the bank's exposure is only say 75,000. So again, the SBA guarantee helps mitigate. I didn't get to collateral. So from a collateral standpoint, what the SBA guarantee is there for, it's really to help mitigate some weaknesses, not all weaknesses. It cannot mitigate losses. So the business is losing money, doesn't mitigate that. If the individual, the principal's credit scores are very, very low, it doesn't mitigate that. But let's say if the only weakness is the collateral, well, let's say the collateral is really nil, almost zero, but not necessarily zero. But the SBA guarantee mitigates that. So that's really what the SBA guarantee can do, is mitigate weaknesses in collateral. And I think I may have said this earlier, from a cash flow, it extends the repayment structure as well to lower the payment. And also for startups, certain industries, lenders will not even take a second look at it unless there's an SBA guarantee. So again, the SBA guarantee is there to help businesses or individuals have access to capital. Must be a small business by SBA size standards. And this next page speaks to that a little bit more. Must be an operating business, has to be a for-profit, located in the US and owned by US citizens or legal permanent residents, and demonstrate a need for credit. You may say, what does that mean? Demonstrate a need for credit. Well, if the borrower is so strong in terms of just cash flow and collateral and credit and all that, where the lender can determine that they really don't need that SBA guarantee, then that means there's not a need for credit from the SBA perspective. So, but the lenders know how to do the calculation or the evaluation. So industries are based on either revenue from an eligibility standpoint or sales. Revenue, or number of employees. So as you can see, manufacturing industries are based on employees, service industries, retail based on revenue. All the lenders have this table to access, and most of them probably know it by heart. So again, for a business owner or for a business to be eligible, they have to meet these guidelines, and some other ones as well. Here's the other one. Okay, so ineligible, nonprofits, speculative, meaning investment real estate. I'll get back to that in a sec. Gambling, illegal activities, adult businesses, religious, etc. Getting back to speculative, again, from an experienced lender. So let's say if someone wants to buy a retail strip center, right? Well, it has to be owner occupied. Owner occupied is the key. So if they're buying real estate, it has to be occupied by the business at least 51%, 51%. So if someone wants to buy a strip center, then you would look at someone and say, well, that's a retail center, that's investment. Well, let's say it's a CPA firm. That CPA firm is going to buy the real estate strip center, and the real estate firm will occupy at least 51% and lease out the other 49. Then it could be eligible. So there are ways, again, to structure a deal. And then the other program, and stop me if you have questions, the other most popular, I should say, program is the SBA 504. This is primarily for real estate and major equipment, heavy equipment, not your desktop computers, but more of your machine shop type of equipment, lathe machines, etc. And the way it's structured is opposed to the 7A, where you have one loan to one lender. With this one, the way it's structured is 50-40-10. So you have two loan payments. So you have one that you make to that lender. Let's say it's a bank. So the bank finances 50% of the project, $1 million project. The bank finances 500,000. The SBA, well, through the CDC, the SBA just guarantees it, if you will. But the CDC underwrites it, and they structure it, and they finance 40%, and then the borrower has to inject 10%. So this program is better, and again, it has to be owner occupied. But if someone is buying real estate, owner occupied real estate, and they want to get into that deal with the minimum amount of equity out of pocket, then this is the program they would probably look at, because they can get into it at 10%. Now, the term is typically 25 years, and that second lien is price fixed for the entire 25 years. At right now, 504 pricing is around 2.7%, I think, somewhere in that neighborhood. So you're talking about a loan for 25 years fixed at 2.75. So you can't beat that. The first lien, the bank's loan, will be fixed, but it's based on their interest rate matrix, could be 6%, whatever their matrix is. And then that last, that asterisk at the bottom where it reads 20%. If it's a startup business, then the borrower has to put in another 5%, that's 15%. And if it's a special purpose property or a single purpose, like a bowling alley or a bowling lane, then there's another 5, so that gets them to 20%. So it will be a 50-30-20 structure in that case. So that was going to be my stopping point before I go into the, that's the purpose, into SBA Resources. Any other questions on the 7A or 504 resources? Okay. Well, stop me at any point, and I'd be more than happy to address it. So the SBA Resources, I talked about the 7A and 504 and the Express Loan programs. But what a lot of people or business owners are not aware of is you have other resources for financing. You have your micro lenders and your community-based lenders, such as the HBDI, Houston Business Development, Inc., over in Palm Center, Martin Luther King area. You have the Lift Fund, used to be known as Axion, off of Chimney Rock area. And then People Fund, I'm not sure where their office is, but they're also a micro lender. The Alliance, really good operation. They have a program where they help people restore their credit. Let's say the credit had some issues, if you will. They have a program where they can assist individuals, businesses, business owners, if you will, to repair their credit. And then the True Fund, they're out of New York, but they have an office here in the aggressive micro lender. So their loans are usually the micro loans. Some of those organizations I mentioned do larger loans outside of micro lending, but the micro loans are 50,000 max, flexible credit terms. I believe one of those lenders, their minimum, I want to say was in 500, not 500, like 590 or 585, something like that. So again, when I'm doing my access to capital panels and I moderate and have lenders on my panel, I make sure I invite the Alliance. That's the one, the Alliance, where they have their credit scores are lower. So again, micro lenders, that's another option for small businesses that they may not be aware of. And I try to push that as much as I can. And average loan size, it seems small, 14,000, but again, most of the micro loans are around 50,000. And then here are the partners. Unfortunately, I was trying to blow this up further for you, but I was having challenges. So these three partners here, Texas Gulf Coast Small Business Development Center, known as SBDCs, SCORE Mentors, and the WBEA Women's Business Center. So these are our three resource partners. We partially, the SBA, we partially fund, FUND, fund these organizations. So we refer them out to everybody. Whenever I receive phone calls or emails from business owners or those individuals who want to start a business, I email them all three of these organizations, their contact, telephone number, the links to the website. They can help free of charge. They do not charge a fee. They can help develop business plans or tweak the business plan, help with financial projections. I'll talk about that in a second. Help you to better manage or understand how to manage your cash flow, social media, strategic planning, etc. So again, it's free of charge, and their staff are comprised of former commercial lenders, CPAs, IT specialists, etc. So right now with COVID-19, everything is really done virtually. They do offer virtual workshops. Now for the workshops, there may be a small fee for that, but prior to COVID, everything was done in person, but they are very good at what they do. I'm always recommending people to them. When I was a lender, if I had a borrower that came to see me and they needed some help, I would say, hey, go see Texas Gulf Coast or go see SCORE. And SCORE is comprised of retired executives. These are individuals who were executives in different areas, different skill sets, and now they volunteer their time to help small businesses grow. So they do a great job.
I did want to, Winston?
Sure.
I didn't want to interrupt you on one thing regarding the microloans, and
Yes.
also did want to plug with SCORE as well. Are any of the microloan programs non-recourse?
That is a great question. And I'm trying to remember some of the questions that I would ask them on my panels. I don't want to say the wrong answer, but oh, wow. I doubt it. Because I do know most lenders, they want someone to personally guarantee the loan. So I'm going to say I doubt it, Patrick, but I'm not 100% sure. I think I'm 99% sure, but okay. Yeah. So no, yeah, most of them, yeah, I just, from my experience, yeah, I think they all require a personal guarantee.
Okay, just so I don't, sometimes I get over talking. Sure. One of the things that non-recourse means you don't necessarily have to pay it back, right? Well, or there may not be a personal guarantee on it.
Yeah, guarantee, right.
So one of the things that there were programs when I was in Minnesota, because they were encouraging so much people to take over businesses, is there were microloan programs that were non-recourse. So you could actually get funding or get certain programs, not all programs, you'd have to qualify clearly, but that they would not come personally after you if you, I wouldn't say defaulted, but if you did not, return the money. Right. So it'd be very interesting. I would recommend to any business owner, no matter the level of your company, really look at these lending programs. The people running them typically are, very high stature, like Winston. They know the ins and outs of lending, and there's getting to be so, they've gotten to be more sophisticated, where they know how the program, how the funds should be distributed. They can actually help you on how to manage your cash flow. There's a lot of great micro lenders out there. Really would not take that list of resources and really memorize it, because I think that's any startup, even doesn't need to be a startup, even just a running company. There's a lot of opportunities with micro lenders to really build out your business. Really very exciting. And one other plug I always give, SCORE on your previous page. Oh, yeah, sure. I'm a SCORE 6th year, as my 6th year in SCORE, a big supporter of SCORE. I cannot rave more about SCORE. And I think Winston will say this, a business that would come to him, even if you have two businesses that come to him, one, side by side, almost exactly the same, but one has a mentor who was in the industry for 25 years and the other does not. I would say 9 times out of 10, if they knew about that mentor, they knew the name of that mentor, and he's respected in the field, the chance of that person getting that loan will increase substantially, because you have that industry experience, you have that person mentoring. And the thing I would say to any of you startups out there, really reach out to SCORE. It's free. You're paying for it with your taxes. So if you want to think if it's not free, say you're already prepaying it, and use it. It's a great resource. So anyways, that's my 2
It
cents.
really is. You said something, Patrick. No, you said something on that, but with just the reputation of SCORE and these guys, when I was a lender, and if someone came to me and when I was a lender and they said, I went to SCORE and I visited with so and so, it said a lot. So I would go, oh, okay, well, if that's the case, let me spend more time on your deal. So you're right about that, Patrick. These guys, SCORE, man, they're fantastic. Man, I have a go-to guy over there now that I refer everyone to, and I told him, I said, I'm sorry for inundating you with all these people, but he's very, just good at what he does. So let me move on. Business plan. So let me just speak to a business plan. Let me go to this right here. So business plan. So in the business plan itself, and I know you guys have probably had so many different conversations about business plans, but at the end of the day, a couple of things. One, it doesn't need to be a very thick manual or binder. Like back in the day, I was a lender back in the mid-90s. Business plan maybe was as thick, and you guys are young, you may not remember the telephone books, but 5 inches thick. Lenders, we didn't like spending too much time going through all those pages. So I just say that as long as you capture the vital information, the executive summary, which speaks to the principals, the individuals, their experience, their education, what they bring to the table, what the services, products that you're offering, all that's in your executive summary. But at the end of the day, even past that, the financial projections are probably, if I had to say what's the most important, would be those projections. So the financial projections, lenders would like to see at least 3 years of projections. We used to call them guesstimates because they're estimates, but guesses, so guesstimates. But we would want to see 3 years. The first year, we'd like to see it broken out per month. So you would have, in essence, 13 columns. The first 12 columns represent 12 months. The last column will be the total. You include of course, your revenue, your sales, et cetera, all your expenses, rent, et cetera, and your net for each month, and then carry over to your total column, that last column. And then year 2 and 3 would be on an annual basis. So you didn't necessarily have to break it out by, you could, but it wasn't required that you have it broken out by month. You would just have like year 2 revenue, total utilities, rent, et cetera, and the profit or the net. But now the other piece to the projections, because you're not done, once you prepare those projections, or as you're preparing those projections or using one of these 3 resource partners that I just mentioned, you have to include those assumptions, the assumptions to those projections. If you don't have assumptions, the lenders are going to just turn you down right away. So you want to include how did you derive at that revenue figure? If it's a restaurant, okay, how many are you open for lunch, breakfast, dinner, and your price per item, menu, if you will, how many tables and chairs, the capacity, hours of operation. So you basically have to, in your projections include how many people you would need to serve for breakfast, lunch, and dinner, or lunch and dinner per day, per week, per month, to generate the revenue that you have in your projections. And then you include your expenses and all that. So you have to include those assumptions to those projections. Otherwise, as I said, it'll be declined. And the other thing too, with projections, where people can shoot themselves in the foot is if you those revenue projections and your profits. I mean, we know as a former lender, I know that was, your baby, your brainchild, you're passionate about it. But if you come in and you say, I'm going to generate 5 million in revenue or 2 million the first year, most lenders have a good feel for the different industries and what those industries can do. So they would push back on that or even just decline it without even having a conversation. But those resource partners I just mentioned, they can help you. They can keep you on track. They have access to the database for the various industries. And if you're going into a certain type of industry, they can tell you, okay, John or Susan, yeah, this is what I'm seeing. This is what the data is telling me on this industry. So you want to make sure you don't exceed these numbers, these ratios. So again, those partners, they are very good at what they do.
Wait, real quick. There was a couple of questions that I made in chat. Are there one thing that was Marco mentioned or asked? Is there any specific technology development type loans or microloans out there, programs for microloans? I'm sorry, for technology development.
There is one, it's, I want to say a small business, it's I can't get the acronym, but there is one that's, well, so let me say there's a loan, there's funding, if you will, capital for that research and development for technology. It's on our website. Unfortunately, I can't think of the acronym for it. I want to say SBIR, like that, but I can email you some information on that, Patrick, and you can share it with the class.
Please do. I'd like to share it with the rest of
Okay.
the
Yeah, I'll do that. Sorry about that. Yeah, there is a program. I'll say program. There's a program out there that exists, if you will, for the technology space.
Okay. And one other question was in regard to, you talked about projections.
Yes, sir.
Is there a specific format like Q1, Q2, or are there any templates that you would recommend using in regard to setting up, when you're setting up your projections when you're making your business plan?
There are various, I've seen different templates out there in my past life, if you will. On our website, we just kind of have some steps, what needs to go into the business plan as far as the executive summary and projections, but the projections themselves, I know that there are spreadsheets out there, templates out there that can be used, but there's not one that's say better than the other, meaning that if someone would go into a lender and they have their package and their business plan and their projections, the lender's not going to push back and go and say, well, you should have had it this way. As long as they're capturing that information, that first year broken out, per month, and then the second, third could be annual or monthly. But so again, there's not any specific one that's preferred over the other from a lending perspective. Now, I will say that probably, things are really advanced now where lenders probably have a template that they can email out. And I think I used to do that myself when I was a lender. I would email information to a balance sheet, template or P&L template. And I can certainly, I'm still working on trying to get a template for you, Patrick. I know you asked me about that, but I'll try to get something from either SCORE or either SBDC and get it to you. You there?
Thank you. Yes.
Well, I thought I've got this. But what I want, good question. Please feel free to, now here, and we're almost toward the end. What I did, Patrick, just kind of pulled in some information on venture capital or venture equity. And I have a couple of slides here that I thought would be very fun here. But, in addition to, financing, debt liabilities, there is such thing as venture equity for startups. Not to read all this to you, but keep in mind with venture capital or equity, those who are investing that equity, they do want ownership, in the business. And I love Shark Tank. I'm sure you guys probably love it too, but they do want some. And Mr. Wonderful, he always tries to just take over, right? But yeah, they venture capitalists, they do want some ownership in the business to the the founder, if you will, what they should do and not do. Some of that could be good. But if they can sometimes be over aggressive, they want to see some, returns of at least 10 times, as far as returns. This guy here, Brad Hargreaves, founder of General Assembly, raised nearly $200 million in funding, but advises most companies shouldn't be venture backed. And there are plenty of other sources of capital out there, angel investors, family offices, small businesses, et cetera. So I believe he's saying that because of what I just mentioned, that venture capitalists, they do want some ownership in your business. So keep that in mind. The Small Business Investment Company Program, which is part of the SBA program, the SBA was a multi-billion-dollar program that began in 1958. They're privately owned and managed investment funds, licensed and regulated by the SBA. And they use their own capital as well. And plus funds borrowed with an SBA guarantee so they can invest into small businesses. But I want to go to this slide. Yeah, here it is, that I thought would be fun. And maybe the students can, type in the answer that they think if they have time. But this one here, who is this? Continental Illinois Bank, owned by John Hines, was the SBIC funded bank that awarded $500,000 in startup capital to a fledgling computer startup. John Hines' foresight in helping this startup was notable. This company, funded by SBA programs at its infancy, is on the verge of becoming the first US company valued at $1 trillion. Does anyone want to take a stab at who they think this is? Anyone? Okay, I'll tell you. I have to make sure I don't see anything. Okay, this one is Apple computer. All right. The next one, I think I have two. I think I have three. In 1993, a former chef in Denver, Colorado, started a Mexican restaurant with $85,000 from his father. The first store funded the growth of a second store. The success continued, and in 1998, McDonald's became an investor. Who do you think this one is? Chipotle. And then, did you have that one already, Patrick?
No, it was a Taco Bell, but it's Chipotle. Taco Bell would be close though.
That would be close. That would be close. No, this one is probably a giveaway. Okay. 22 years ago, this business started out of a grandmother's basement. The owner was an athlete that struggled with constantly changing out of sweat-soaked t-shirts. The owner conducted research on synthetic fabrics and their athletic benefits and designed the first t-shirt engineered with moisture-wicking performance fibers. Who do you think this is?
Under Armour?
You got it. Under Armour. So with that, I think that was last one. So again, I'm going to scroll down to this last page of some of the SBICs in the Houston. Oh, there it is. So we have Main Street. Oh, let me back up. So Main Street Mezzanine is one of the SBICs in Texas. Parallel Investment Opportunity Partners, Stella Capital SBIC, and then the rest of these are Texas located, Live Oak, Blue Sage, independent bankers. So there's some SBICs in the Houston market. We've done some webinars with with Main Street. They typically want to invest at a minimum, $5 million minimum. So yeah, so some of these guys, they won't even consider, say, a small amount, but I just thought I'd include the slide. But with that just kind of brings me to the end. And what I'll do, Patrick, I'll email you these slides if you want to share those with students. That way they can have the resource partner contact and those micro lenders as well.
That would be great. That would be great. And just as a note, we will also post the video on the McNair Center website. I'm sorry, the YouTube page. So we can all, if you all saw it today, and if you missed anything, you can check it up on the website. And also, we'll link the document. So when they do check out the video, they can access your document as well. So it's no problem.
Perfect. Are there any closing questions that anyone may have, Patrick?
I think you answered a lot of them. Anyone have any questions at the end?
I have a question.
Sure.
Okay. Go ahead.
Does SBA work with U.S. territories like Puerto Rico?
Yeah, I believe we do have an office that is responsible for Puerto Rico.
Oh, okay. Thank you.
You're welcome. And I can, I'll tell you what, if you click, once you have these slides and click on the link or type in, you can click on, there's a section where you can search for SBA offices, regional and district offices. And so that way you can just type in the search bar Puerto Rico and it should give the contact.
Okay, awesome. Thank you so much.
You're welcome.
There's a question in chat. How does it work, the application for UNA Bank? UNA Bank for the SBA. UNA Bank for the SBA.
Well, if I understand the question, so any bank lender, it could be a credit union, it could be a non-bank lender. Back in the day, there was Heller Financial and some other companies that became SBA lenders. But what happens is the borrower, the business owner, will approach the bank. Contact them probably online these days, and get in contact with one of the lenders. And most lenders have their applications online on their website. So, and their checklist as well. So the person would just go ahead and access the application, the checklist, provide the, tax returns, personal financials, et cetera. And then the lender, and again, most lenders they do prefer having a conversation before it's good to have that conversation before you apply, because that way you'll know what the lender is going to ask for and what they need. And then once you apply, some lenders have lending authority up to a certain dollar amount. They can approve it themselves. And some lenders, they send it to a loan committee. And then others have what they call a centralized underwriting department that could be in another city away, like say, for instance, you're in Houston, they could be in California underwriting your loan request. But yeah, you go through a participating SBA lender, and they typically have similar structures as far as approval processes.
Perfect. Thank you. One last question.
Mhm.
Is there any SBA programs, and I think you hit on this a little earlier with the microloans, but maybe there are some other areas too, for
Mhm.
minorities or people of color?
Well, there's not an SBA program itself for a lending program, a loan program, but there is a program for women-owned businesses that are interested in contracts, federal contracting. So it's called Women-Owned Small Business, WOSB. But as far as an actual a loan program specifically for minorities, no, we don't have that.
Okay. Is there any SBA, I don't want to say microloans, but there any like support, where because some communities,
Yeah,
specifically on different,
Understood.
I grew up in the South Side,
right.
and the SBA, they're really South Side Chicago. They really had to do a lot of outreach
Mhm.
because a lot of the people there in those communities, they didn't use banks.
Correct.
Are there any programs that help maybe people who are, I don't want to say in poorer areas, but in areas where
Underserved markets?
yes.
Yeah, no. So the SBA encourages lenders to do more in those communities. We have right now we have webinars right now. Well, not just webinar meetings with lenders. Trying to encourage them. Hey, you need to maybe do more. Keep in mind you have the underserved markets. Prior to COVID, prior to when I started, of course, in my role as an outreach is to go out to the communities and have the financial literacy workshops, and bring in lenders together for panel discussions on, like I mentioned, 5 C's of credit. So that's kind of value we want to bring to the communities once things back to whatever normal is going to look like again, and bringing lenders together to just encourage them to do their part, if you will.
Absolutely.
Yeah. Mhm.
Well, I think that's great. I think we had a lot of great questions today, and really an amazing, I really love the presentation, Winston. I mean, the SBA, the work that you do is just phenomenal. And the impact that you have in helping small businesses cannot be, undersung. Really just an amazing effort that you're doing. And we're very appreciative today. So thank you everyone for coming. I'll wrap it up. We're a little bit over an hour, but we try to keep it tight. But thank you everyone for coming in. If there's any questions, we had a few questions in the chat. We will be posting on the McNair YouTube channel and also on the LinkedIn and on our Instagram. I got to keep up all our social media of this event, so you can reach out to those and click through. Additionally, the slides, Winston mentioned, he will be, Mr. LeBay will be sending me the slides. I'll make sure that's also linked on the YouTube, so you'll be able to access that as well. And once again, thank you very much, Mr. LeBay. It was just a very amazing presentation, and thank you very much for your time.
Thank you so much, and thank you, class. I appreciate you guys very much. Thank you so much. Okay.
Thank you, sir.
Thank you.